In this video, I'm gonna walk you through how asset location works and why it matters. Hey there, my name is Jacob Duke. I'm a certified financial planner and I'm the founder of Rivertree Wealth. I'm here to help you retire with confidence. So when it comes to asset location, maybe this is a new concept to you or maybe you've heard of it before, but the general idea is this. We wanna make sure we align your investment types or your asset types, such as a stock, a bond, cash, money markets, treasury bills. We want to align those asset types with the account types, such as traditional IRA, Roth IRA, or taxable account, because whenever we do that, we can make your portfolio more tax efficient. So let's take a minute and break this down and look at this visually, that way we can make more sense of it. So right here we can see this is what a 70-30 allocation across, let's call it $1 million, will be allocated with no asset location. So this is the way to understand this is all of the green, the different colors of green, that's still stock, but just different sub-asset classes, if you will. We also have bonds and we also have treasury bills. Now, this is not investment advice. I'm not saying, hey, go be 70-30 in your portfolio as you enter retirement or even invest in bonds or treasury bills or stocks or anything like that. This is just an example to kind of emphasize or show you how this would work. And what we're gonna look at here is whenever we have no asset location. Whenever we look at this traditional, which is like a traditional IRA or 401k, meaning it's tax deferred. We also have a Roth, which is after tax, meaning we paid the tax on the front end when we put the money into that account. And then also we have a taxable account, which is after tax money that went in, but also will be taxed on the back end when it comes out, either as qualified dividends or non-qualified dividends, or perhaps long-term capital gains or short-term capital gains. But the key here that I wanted to show you is that in a normal 70-30 portfolio with no asset location, what we can see is every single one of these account types are invested the exact same, meaning they are all split up 70-30. And here's how that would work. We can see that we have the same amount in stocks, we have the same amount in bonds, and we have the same amount in T-bills across the board. So every single one of these account types, they're actually invested the exact same. So the problem with this is that if you think about it, the Roth is not actually being used to its fullest advantage, meaning all money that grows in a Roth is growing tax-free, assuming you meet a couple different rules, and those rules are that you are aged 59 and a half and the account has been open for 5 years whenever you distribute money from it. But if you have bonds or treasuries or some sort of fixed income asset in that account type, you're not growing the Roth as much as you possibly can, meaning you're giving up some sort of tax-free potential income in the future. So you'd probably want to have that invested slightly more aggressively than including some different bonds or fixed income in that account type. Also, when we take a look at the taxable account, this one is taxable on an annual basis. So if you have a brokerage account, you probably receive a 1099 from it every year, meaning you've got qualified dividends or non-qualified dividends, perhaps some interest, or maybe you realize some capital gains in that account, and you're gonna pay taxes on those gains every single year. So if that's the case, we probably want to at least minimize some of those things, such as your income, your dividends, perhaps capital gains. We want to minimize that as much as possible so that we can delay or defer some of those taxes into the future or minimize them in general. So whenever we have fixed income, such as treasury bills or bonds or some sort of other interest-bearing assets in the account, we're going to pay more income taxes every year, and those taxes will be paid at a normal income rate or ordinary taxable income. So here's the key. We probably want to have more stocks in that account as well, and we want to and do some asset location here to make sure we're optimizing the account types to their advantage. So what does this look like in practice? Well, if we look at what the same 70-30 portfolio would look like whenever we do some asset location, here's what that might be. Well, we've got the traditional IRA, we've got Roth and taxable, but now they're not invested the exact same across the board. They're actually each invested differently. Now, the key here is that you don't end up at a different overall portfolio allocation. We still have a 70-30 portfolio, but because of how this works, we're going to actually have our assets correctly located in the correct account types as much as we possibly can. So, for example, the traditional IRA, we probably want to have our bonds and our fixed income, such as treasury bills or normal corporate bonds in that account for a couple different reasons. Number one, that account is tax sheltered, meaning any interest, any dividends, any capital gains that are realized in that account, you don't have to pay taxes on that in that particular year. You get to pay the taxes on that whenever you distribute the money in the future. So it's called tax deferred. You get to defer those taxes as far into the future as you possibly can. Obviously, you will have RMDs on that account one day, so you will have to start distributing once you're either 73 or 75. But if we're going to have normal income taxes on the interest and dividends, we probably want to put that in the traditional IRA so we're not paying that every single year. So that's step number one. Move all of the fixed income products, if you can, into that traditional IRA. Additionally, if you have high growth stocks or high growth assets in that traditional IRA, you're kind of going to just be building up a larger tax bill for yourself when RMDs roll around. So it might make sense to almost curb the growth in that particular account type because of those couple of reasons. And because of that, what we can do is we can shift all of the stocks over into the Roth account, but also that taxable account. Now, why would we want to do this in the Roth account? Well, the benefit of a Roth is that it grows tax-free. And then also, whenever you distribute money, if you meet a couple of different rules, if you distribute your funds from that, you'll also receive a tax-free income from it. Now, those two rules are that you have to be 59 and a half and the account has to have been opened for 5 years in order to take all money out tax and penalty free. Now, you can access money from your Roth before 59 and a half and before you have reached that 5-year window of having the account open, and that's because you can take your principal or whatever you've contributed, you can take that out at any point regardless of your age or how long the account has been open because you've already paid the taxes on it. So we want to use that Roth account to its advantage. So if we want to grow that account, we want to have the highest growth assets in that account. So that's going to be your stocks over your bonds or your cash or your money market, right? So we want to hold all stock in our Roth account if we possibly can. And then the taxable account, since we're going to pay income taxes every single year via a 1099 that will be issued to you, we probably want to have the lowest tax impact every single time if we can do that. So that means that we want to hold the stock funds, which are going to produce hopefully qualified dividends for the most part. It depends on your holding period, but I would say 90+% of your dividends out of a stock fund or an individual stock are going to be qualified, which means they get to receive a long-term capital gain treatment, which is much cheaper than the normal income tax rate. So because of that, we want to hold all stocks there, but then also we want to limit the bonds or treasury bills or some sort of fixed income assets in that account, because anytime you receive interest or dividends from a bond fund, what you're going to do is you're going to have to pay normal or ordinary income taxes on those interest or dividends because they would be what's called non-qualified, which means that you're going to pay a normal income tax rate or a short-term capital gain rate and instead of the long-term capital gain rate, which is cheaper. So that's visually how that would work. That's how you can reallocate or distribute your different holdings into different accounts so that you are what's called asset located, or you're using asset location to your advantage. So what is this? Why would we do this? Well, just going back really quick to refresh, anytime you add money into a traditional IRA, you are not paying tax on the front end, meaning you get to deduct that from your income. Right? Now, when you take money out in the future, you will have to pay ordinary income tax on it every single time. Now, that is regardless of the investments underneath or inside of that account. So if you own all stock in that traditional IRA and you receive dividends or have long-term capital gains, guess what? It doesn't really matter, because anytime you take money out of a traditional IRA or a traditional 401k, any sort of tax-deferred account, you're going to pay ordinary income tax regardless of the type of underlying assets that are in the account. So that means, again, you would probably want to hold the same tax type in terms of fixed income is going to produce a normal income. Anytime you take money out of this, it's going to be normal income. So you'd want those two things to be together in the same account because there's no advantage or disadvantage of doing that. Next, we want to take a look at the Roth, which anytime we add money to a Roth, we are paying tax on the front end. So we're putting in what's called after tax. So we're paying that ordinary income tax to put money into it. But when we take that money out, again, we were going to receive no tax on that or no penalty, assuming that we're 59 and a half and we have that account open for 5 years. Again, we can take money out before then if we're taking out our contributions. Different video for a different day. And then finally, we have the taxable account. Okay, so you're going to pay normal income taxes on the income you've earned. So it's after-tax money that you're actually putting into a taxable account. You're not getting any sort of deduction. But whenever you have dividends or interest or some sort of capital gain every single year, that is going to be taxed whenever it is happening. So you don't necessarily get taxed whenever you distribute money from the account. You're going to get taxed every single year whenever you have income such as dividends, interest, or you have short or long-term capital gains based on price appreciation. So those are how those different accounts are actually taxed. Now, why does this matter? Well, whenever we have a stock, stocks can receive qualified dividends. I already mentioned this, and they can also have long-term capital gains if you hold that particular holding for over 365 days or longer than 1 year. Bonds, they're always going to have interest or dividends. If it's a bond fund, they're always going to have short-term or non-qualified interest or dividends, meaning you're going to pay normal income tax rates on the income that those bonds or treasury bills or whatever it might be that they're producing. You can receive a long-term capital gain rate if you hold a bond fund for longer than a year and it has appreciated. Now, the idea of bonds isn't so much to have asset appreciation as it is to have income coming to you. So if you're thinking about bonds and like, oh, I'm going to just grow the value of my bond, well, it doesn't really necessarily work that way most of the time. You're going to have some appreciation from time to time. But if you hold a bond to maturity, you're just getting your par value back essentially. So bond funds, you could get some appreciation there, but really what you're fighting for when holding a bond is that interest. But that interest is always going to be coming to you as normal income, meaning a higher tax rate than the long-term capital gain rate. And then finally, cash or T-bills, again, you're going to get non-qualified dividends or interest on this. Probably no price appreciation across the board here for the most part, but you're going to get, again, no qualified dividends or interest, which means you're going to pay normal income tax rates on that. So because of that understanding and knowing what that looks like, that means that we probably want to hold our bonds and our cash and treasury bills, since they're not going to receive any sort of tax benefit whenever we receive that income. We probably want to hold that in the traditional IRA. And the reason for that is, again, any money we ever take from the traditional IRA is going to be taxed as normal income anyway, regardless of the underlying assets. Now, the stock, anytime we have individual stocks or stock funds, again, we can qualify for long-term capital gains, but also qualified dividends. We'd want to hold that in the Roth, going back to what I mentioned to earlier about growing and appreciating that account type more than any other, specifically because it grows tax-free. But then also we want to have that in the taxable account so that we can minimize our taxes annually. And if we do have any dividends that come in from our stock funds, which will have at least some, those would hopefully be qualified rather than normal income tax rates, meaning you would go from, example, if you're in the 22% income tax bracket, you would pay 15% on the dividends, which is the long-term capital gain rate, rather than that 22. So a 7% difference there just on those two tax brackets, just for an example. But that's overall how asset location works. We want to make sure that we're aligning the asset class or the investment type with the account type in terms of taxability, so that we are optimizing your portfolio. We're reducing your future taxes, but we're reducing your taxes annually. So hopefully this is helpful for you as you continue to navigate your retirement plan and understand more about asset location. If you have any questions, leave them down in the comments below. Also, if you're interested in working with me or the team here at Rivertree, you can click on the link down below and we'd be happy to have a conversation with you. Thanks so much, and we will see you next time.